Hello and welcome everyone to another video for CFA Level 1. Today's video will be a bit different because it is a revision of an existing reading of financial reporting. We will not be studying it. So mind you guys, we will be doing a quick revision of it. The reason for the revision is that one of our students has asked for the revision since they are having level 1 exams in this window. So I thought that it is good that we touch base that reading for the help of the student. Okay. The name of the topic is Analysis of Inventory. Okay, and we should take roughly around 20 to 25 minutes in order to cover the entire reading. One more information, the 2-pager note for this topic, analysis of inventory, is in my Telegram channel, so you can go and check it out. In 2 pages it has summarized everything possible, as well as important. It has highlighted also the important, so you can refer that and you can study that in conjunction along with the class for today. Okay, analysis of inventory. Analysis of inventory is one of the reading for financial reporting, and it has basically 3 major concepts. Okay, analysis of inventory, you will see there are 3 major concepts. There are various things here and there. We should simply ignore. These are noise. The entire content of analysis of inventory can be broken down into 3 major contents. One is inventory measurement. Okay. Second is analytical aspects. And the third is presentation and disclosure. Okay. Now, out of these 3, this is the most important. Okay. Analytical aspect is second, and the third is presentation and disclosure. Usually, you should not expect a question from presentation and disclosure, because inventory measurement and analytical aspect are more important. They have a deeper concepts to cover. Okay. In inventory measurement, we will learn inventory measurement under IFRS and under US GAAP. Again, since it is a revision video, I assume that you know what is IFRS and what is US GAAP, so we will not getting into those details. When you talk about analytical aspects, it talks, it is standard agnostic. It talks more from a lens of impact of inventory on different ratios. Okay. And presentation and disclosure again discusses from the lens of IFRS and from the lens of US GAAP. Okay, so are we clear with the theme of the entire chapter? So without wasting another second, we are moving to inventory measurement. Okay. Okay, so first we will see what are the aspects basis which the inventory measurement we are discussing. What are the application in IFRS and what is the application in US GAAP. Okay, guys, just give me a minute. Okay, the aspects. So first is the initial recognition. What is initial recognition? So whenever you are purchasing an inventory, whenever I am purchasing an inventory, the first time when that inventory is entered into the books, what is the treatment of that? So IFRS says that initial recognition is always at cost. US GAAP is also saying that initial recognition is always at cost. Simple. So first time when the inventory is recorded in the books, both of them are saying that okay, record it at cost. Then there is subsequent measurement. Subsequent measurement means presenting in balance sheet. Then there is subsequent measurement. it is saying, IFRS is saying that lower of cost or NRV. What is NRV? Net realizable value. Okay. Lower of cost or net realizable value. Okay. This is also same. Now an important question that arises over here is what is net realizable value? So the formula for net realizable value is given as expected sale price minus expected selling cost minus cost of completion, if any. Okay. So in subsequent measurement as well, IFRS and US GAAP are same. It is lower of cost or net realizable value. Now, what is net realizable value? Again, net realizable value is the same for both US GAAP and IFRS. What is it? It is the expected selling price, which is the price at which we are expecting to sell, minus the expected cost of selling, means any cost which is needed in order to make those sales, minus cost of completion of goods, if any. So, it is assuming that there might be some work in progress product as well. So if there are no work in progress product, if it is a direct, means if it is a finished goods, then there is no cost of completion. Okay. Special situation. There is no special situation in case of IFRS. But yes, in US GAAP there is a special situation. Yes, there is a special situation. What is the special situation? The special situation is that above rule of lower of cost or NRV will not apply when entities using retail slash LIFO method. Okay, guys, again we will not discuss in detail what is a retail or LIFO method. The full form of LIFO is last in first out. Okay, and the retail method is used usually when goods are separately identifiable. Okay, so what will be used if lower of cost and NRV cannot be used? In that situation, it will be lower of cost or market. Okay, so in retail and LIFO, it is not lower of cost and NRV, it is lower of cost and market. Okay, now what is market? This is very typical. See, market will be less than equal to NRV or greater than at least NRV minus normal profit margin. Guys, so this is something which we have to be very clear with. Market will be within the range of NRV minus the normal profit margin or the NRV. In case market is greater than NRV, then we are considering that if market comes out to be greater than NRV, then we will assume market is equals to NRV. Okay, guys, I understand you can find it to be confusing, but it is not confusing. See, we have to be very clear. In IFRS or US GAAP, the rule is same, cost or NRV. Okay, but when we are talking about LIFO and retail, then it is not NRV, it is market. But when you are talking about market, market is nothing but based on NRV. It is within the range of NRV minus the profit margin and the NRV. If at any point of time market becomes more than NRV, we'll assume that market is equal to NRV. So in no case, market value will be more than NRV. Are we clear? So in no possible case, we have to be clear, no possible case, market will be greater than NRV. Are we clear, guys? Guys, are we clear? Okay. Okay. The last point that we need to discuss is that suppose NRV is lower than cost. Okay. Very important situation. By C, your initial recognition of the inventory has happened at cost. Okay. In the balance sheet, you will value it at NRV or cost, whichever is lower. If NRV is higher than cost, then I don't have a problem, because in the balance sheet, because the original entry which was made in the books was in the cost, and in the balance sheet also it will be at cost. I don't have a problem. Suppose the value of NRV falls below cost, then I will have to bring the value of inventory to NRV. So I will write down the inventory. Okay, write down the inventory, and the delta. What is the delta? Delta is cost minus NRV, book loss in PNL. Book loss in PNL. Guys, are we understanding? If NRV is lower than cost, then I will have to book loss in PNL. This treatment is again the same in US GAAP, but there is one exception. Suppose in subsequent year, NRV increases more than cost, or NRV increases, then there will be a write up of inventory value. There will be a write up of inventory value. But what will, and a write up of inventory value, profit will go into PNL. Profit will go to PNL. Okay. But maximum profit would be equal to loss earlier booked in PNL. So in no case the write up of inventory can be more than the value it was written down. So if, for example, there was a write down of inventory by 100 rupees or $100, then your inventory cannot be written up by more than $100, irrespective of the actual value that it is now in the market. Okay. So if it was written down by $100, it will written up by $100. Okay. It can be written up by $80, can be written up by $50, but not more than $100. This write up feature is not there. Very important. Not there in US GAAP. So in US GAAP, write down of inventory is allowed, but write up of inventory is not allowed. Guys, are we clear? Guys, are we clear? Guys, are we clear? With this, guys, we have done our first portion of inventory measurement. And this is the most important question. 6 or 7 out of 10 times, if the question comes out of analysis of inventory, this will be the portion from where the question will be asked. Now we come to the analytical aspects. What are the analytical aspects we are talking about? We are talking about impact of inventory measurement on ratios. Okay. So let us take couple of instances. Suppose we have written down the inventory write down. Now you have to just remember all the ratios where inventory was one of the component, either directly or indirectly. How indirectly? Indirectly, it can be by the way of being a part of the current assets, okay, and where the current assets is used in the ratio, or being the part of a total asset where total asset is used as a ratio. So the first ratio we will talk about is current assets. Sorry, current ratio. What is current ratio? Current ratio is current assets by current liabilities. So if there is a write down in inventory value, your current asset value will go down. So your current ratio will go down. Guys, very simple. Second ratio that we will talk about is inventory turnover ratio. Correct? You had inventory turnover ratio. What is inventory turnover ratio? Inventory turnover ratio is COGS by average inventory. If the inventory is going down, your average inventory will go down. So your inventory turnover ratio will increase. Correct? The third is total assets turnover ratio. What is total assets turnover ratio? It is sales by total assets. Now, if inventory is written down, your total assets will write down. So your total assets turnover ratio will increase. Now we talk about similarly, we can talk about all possible ratios. Guys, current ratio, inventory turnover ratio, total assets turnover ratio were just example. Similarly, we can talk about return on total assets, return on assets. These are profitability ratios. Guys, are we clear? So we have to see what is the impact of inventory write down on these ratios. Correct? Then we come to another important topic is that in situation of inflation, okay, if there is a situation of inflation, what will be the impact of inventory in case of LIFO and in case of FIFO? Guys, we both know what is LIFO and FIFO. LIFO is last in, first out. What does it mean? What does last in, first out means? It means that inventory which is bought at the last will move out first, which means we will sell, or we are assuming that we will sell the most newest product. The one which was procured at the last will be sold first. In FIFO, we are saying first in, first out, which means the product which was purchased the oldest, or the oldest product in the stock, means which were purchased earlier will be sold first. So these are just ideological differences. In the first one, we are saying that the product which is purchased at the last will be sold first. In the second, we are saying product which was purchased earlier will be sold first. However, this simple distinction in ideology will create a lot of differences in closing inventory, will create a lot of differences in COGS in case of an environment where prices are changing. How? Suppose there is an inflationary environment. We know what is inflation. Inflation is a situation of rising prices. Correct? So if we take a product A, okay, and if we take a timeline of 12 months, assuming only one unit of A was produced every month, was purchased every month. So one. Okay. In situation of inflation, suppose we assume that 100, 101, 102, 103, 104, 105, 106, 107, 108, 109. Okay. What is LIFO assuming? LIFO is assuming that the last product will be sold first. So it is assuming it will be 109 will be sold first, then 108, then 107, then 106. Suppose we assume 4 units were sold. Okay. Then what is the value of inventory that will be recorded in the books? The value of inventory that will be recorded in the books will be 100 to 105 addition. Guys, the value of inventory that will be recorded in the books will be 609, 615. That is 100, 100 plus 100, 100, 203. Correct? If we take the same example with FIFO, in FIFO we are assuming that the earlier products are sold first. So the closing inventory will be 104, 105, 106, 109. This will be 39, 639 if I am not wrong. So what do you see? In case of LIFO, in case of an inflationary environment, my closing inventory will be lower. Closing inventory will be valued at lower. But in case of FIFO, my closing inventory will be valued higher. However, it will be opposite in case of COGS. Okay, COGS is vice versa. Similarly, COGS is vice versa. Guys, are you getting it? Guys, are you able to understand this concept? How does an inflationary environment will impact my closing inventory and COGS in case of LIFO and FIFO? This is nothing but this is the analytical aspect. So in the question or in the exam, you can be given the similar type of question. 10 inventory is given, the order of buying is given, and they will ask to calculate the inventory value in case of FIFO or LIFO, or calculate the impact on the ratio in case of a FIFO or LIFO. Guys, this is a simple thing that they will ask. And since you are not able to understand it conceptually, you will feel lost. So this is a simple thing that we need to look at. Okay. So guys, with this we have covered a major aspect of impact of inventory on different ratios. Now the remaining portion we will study it from our power book. Okay. One topic that we need to study is LIFO liquidation. What is LIFO liquidation? Guys, what is LIFO liquidation? A LIFO liquidation occurs when a LIFO firm's inventory quantity declines. So basically a firm which is operating or using the LIFO model, when their inventory declines, it is known as LIFO liquidation. Older low cost inventories are included in COGS compared to a situation in which inventory quantities are not declining. LIFO liquidation results in higher profit margin and higher income taxes compared to what they would be if the inventory's quantity were not declining. Very important. You may be simply asked a direct question that in case of LIFO liquidation, tell the impact on profits or taxes. Okay. Increase in profit margin from LIFO liquidation are not sustainable. Very important again, because since this profit is driven by a sudden decrease in the quantity of goods, and because of the reason that you are following LIFO, thus you won't be able to sustain it for longer, and thus the quality of earnings, mark my word, quality of earning, very important. Earnings quality is an important aspect in financial reporting analysis. So quality earnings reduces because this is not a quality earning. Management could use LIFO liquidation to artificially inflate current period earnings. Yes. Example of window dressing. This is an example of window dressing. Guys, mark these words, important, very important, window dressing. So now we will start with presentation and disclosure. See guys, presentation and disclosure as a topic is not very important. Okay. But some things here and there you can just read. Otherwise, analytical aspects and the inventory measurement were the most important part of this topic. Presentation and disclosure. Inventory disclosure, usually found in financial statement footnotes, are useful for evaluating a firm's inventory management. Definitely, these disclosures are helpful for further evaluation and analysis. Require inventory disclosure are similar for US GAAP and IFRS. Again, very good. Maximum requirement for them are similar. Include the following: cost, cost method used. Okay, just ignore this low. Total carrying value of inventory. Carrying value of inventory reported at fair value less selling cost. Cost of inventory recognized as an expense during the period. Basically COGS. COGS is reported in P&L. Okay. Amount of inventory written down during the period. Basically lower of cost or NRV, where NRV was lower. Okay. Reversal of inventory write down, basically write ups during the period. Guys, this is only possible in IFRS. Only possible in IFRS. Why? Because in US GAAP, inventory write ups are not possible. So reversal of write downs cannot happen. Okay. Merchandising firms such as wholesalers and retailers purchase inventory that is ready for sale. In that case, inventory is recorded only in one account. Manufacturing firms usually report inventory like raw material, work in progress, finished goods. Okay. So basically, those who are merchandising firm or trading firms, they simply purchase material and sell it. That is why they only have one form of inventory. However, in manufacturing firms, they have raw material, they have work in progress, they have finished goods. Analysts should also examine the relationship between sales and finished goods. Finished good inventory growing faster than sales may indicate declining demand in excess of obsolete inventory. So again, this is important. It is saying that from an analysis point of view, you need to understand the relationship between the inventory and the sales. If the inventory is increasing, the sales is not increasing, what does it mean? It means that your stock will pile up. When the stock will pile up, there are chances NRV will fall down. When the NRV fall down, what happens? It gives you a hit on the PNL. Guys, are we clear? Okay. So with this, we have done our revision of analysis of inventory. I hope you found it useful. Again, I'm reiterating the two-pager notes for analysis of inventories in my Telegram channel. Guys, please visit and see. And happy studying. Best of luck for your exams. I hope you will do good and pass with the flying colors. We will meet again in the next class.